You think you know who owns your home. You've been sending that payment every month for years, but the company that took your money last month might have nothing to do with who actually owns your debt. The real owner could be in a tower in Lower Manhattan, or tucked inside a pension fund in Norway, or split across 12 different financial instruments you've never heard of. Most homeowners never find out, and the ones who do usually find out at the worst possible moment. There's a reason the system is built to keep you confused. Welcome to Untold Wealth Theory, where the financial world stops pretending and starts making sense. Let's start with something simple. You buy a house, you go to a bank and sign a stack of papers, you shake someone's hand. From that moment, you believe you have a deal with that bank. You'll pay them every month for 30 years. Eventually the house is yours. That's the story they tell you. And that story is almost entirely fiction. Within 60 days of closing, sometimes less, but no odds, that bank has almost certainly sold your mortgage. Not the house, the mortgage. The debt itself gets sold. The right to collect your payments, month after month, year after year, packaged, priced and sold to someone you'll never meet. This isn't new. It didn't start in 2008. And it isn't illegal. It's the entire design. Here's the word you need to understand. Securitization. It sounds technical. It's meant to. But the idea is almost shockingly simple. A lender collects thousands of mortgages. Yours, your neighbours, mortgages from Tampa, Portland and Cleveland. They bundle them together. That bundle gets turned into a security, a financial product, something that can be bought and sold on Wall Street just like a stock. The lender gets their money back immediately. They don't have to wait 30 years. They can take that cash and write 1,000 more mortgages tomorrow. This is why banks are so eager to lend. Not because they believe in home ownership, because mortgages are inventory. Now here's where it gets uncomfortable. When your mortgage gets sold into one of these bundles, technically called a mortgage-backed security or MBS, it can get sliced and restructured. Your individual loan disappears into a pool with thousands of others. That pool gets divided into tranches, which is just a French word for slices. Investors pick the slice they want based on how much risk they're willing to take. The safest slices get paid first. The riskiest get paid last. But they promise higher returns to sweeten the deal. By the time this process is done, no single person or institution may own your mortgage as a standalone debt. Pieces of it could be held by a hedge fund, a pension fund, an insurance company, and a foreign government all at once. This is the part most people never think about when they sign that closing paperwork. And before you dismiss this as abstract financial noise, think about what it means the moment something goes wrong. If you've been watching this channel, you already know the financial system is full of moving parts designed to obscure who controls what. If this is your first time here and you want to keep pulling on this thread, hit subscribe. Untold Wealth Theory goes where the mainstream glosses over. So what happens when you fall behind on payments? Or when you want to negotiate a modification? Or when you want to find out who actually has the legal right to foreclose on your home? This is where the system shows its teeth. The company you send your payment to every month is called your servicer. They handle the day-to-day, collecting money, managing escrow, answering the phone when you call. But in most cases, they don't own your loan. They're a middleman, paid a small fee to manage the relationship while the actual owner sits somewhere far removed from the transaction. After 2008, there were thousands of foreclosure cases where banks couldn't produce the original promissory note. That piece of paper, the actual legal document proving ownership of the debt, had been lost somewhere in the securitization chain. Courts in multiple states threw out foreclosures because no one could prove who had the right to take the house. You didn't hear much about this in the news, but it happened. And it happened because the system was moving too fast, packaging and repackaging debt so quickly that the paperwork couldn't keep up with the money. Let's talk about the entities doing most of this work today. Because here's the part that almost never makes it into a mainstream financial news segment. The biggest players in the US mortgage market aren't traditional banks. They're companies you've probably never heard of. Rocket Mortgage, United Wholesale Mortgage, PennyMac, Loan Depot. These aren't banks in the way most people imagine banks. They don't take deposits. They don't hold your savings account. They exist specifically to originate loans, create the debt, and sell it off as fast as possible. In the industry, these are called non-bank mortgage lenders. Outside the industry, they're sometimes called shadow banks. that phrase gets pushback from the companies themselves. They prefer independent mortgage bankers, but the core fact remains. They operate largely outside the regulatory framework that governs traditional banking, and they've taken an enormous share of the mortgage market. By the mid-2020s, non-bank lenders were originating more than half of all mortgages in the United States. In some years, closer to 2/3. Think about what that means. The majority of American homeowners got their mortgage from an entity that the moment they signed was already planning to sell that debt. Much of that sold debt doesn't go to private hedge funds right away. It goes through two government-sponsored enterprises that most Americans have heard of but few truly understand, Fannie Mae and Freddie Mac. These two entities sit at the centre of the entire US housing market. They don't lend money directly to home buyers. Instead, they buy mortgages from lenders, bundle them into mortgage-backed securities, guarantee them, and sell those securities to investors around the world. In exchange for that guarantee, they charge a fee, and that fee is how they make money. The implicit guarantee from the federal government, made explicit in 2008 when the government placed both entities into conservatorship, means investors see Fannie and Freddie-backed securities as nearly as safe as US Treasury bonds. That keeps mortgage rates lower than they'd otherwise be. But it also means there's a direct line between your mortgage and global capital markets. The money funding your home purchase might have come from a pension fund in Japan, a sovereign wealth fund in the Gulf, or an insurance company in Germany. Your monthly payment travels the same route in reverse. Here's the part that should sit with you for a moment. This system, securitization, non-bank origination, government guarantees, global investors, was largely built to make credit flow more freely. More people could get mortgages, rates stayed competitive, the market stayed liquid, and for long stretches it worked exactly as advertised. But the 2008 financial crisis showed what happens when the incentives inside the system stop being about the quality of the loan and start being about the volume of the loans. When the entity writing your mortgage knows it's going to sell that debt within 60 days, the question of whether you can actually repay it matters a lot less. That's not a bug in their thinking, that's just math. The risk isn't theirs to carry. That misalignment between who makes the loan and who holds the risk is still present in the system today. The rules tightened after 2008, loan quality standards improved, but the fundamental structure hasn't changed. Lenders still originate to sell, servicers still manage loans they don't own, investors still buy income streams from people they'll never meet. So what does any of this mean for you? Not abstractly, practically. If you have a mortgage right now, it's worth knowing who your servicer is and understanding that they are not the same as your lender, and your lender is probably not the same as whoever owns your debt. Your servicer's name and contact information should be on every statement you receive. If you ever hit financial hardship and need to negotiate a forbearance or a loan modification, you're not negotiating with the real owner of the debt. You're negotiating with the servicer, who has rules, restrictions and contracts with the actual investor that limit what they can offer you. Knowing this changes how you approach that conversation. If you ever want to know where your mortgage actually ended up, the MERS system, Mortgage Electronic Registration Systems, tracks transfers of mortgage ownership for most US loans. You can look up your property. Most homeowners never think to do this. The ones who do often find a chain of transfers they had no idea existed. This isn't about fear, and it's not about anger, though both of those reactions make sense once you understand the full picture. It's about knowing the actual rules of the game you're already playing. The financial system is not designed to explain itself to you. It's designed to function around you, and in many cases without you ever understanding it. That doesn't mean it's secretly malicious, but it does mean the information asymmetry is real, and the people who know how it works have a consistent advantage over the ones who don't. Your mortgage, probably the largest financial obligation of your life, is a product. It was packaged, priced and sold the moment you signed. You deserve to know that. You deserve to understand who benefits from that structure and who assumes the risk when things go wrong. Because historically, the risk finds its way to the homeowner. If this changed how you think about something, about the house you own, the mortgage you carry, or the financial system around you, leave a comment below. Tell me what part of this landed hardest for you. I read them all. And if you know someone with a mortgage or someone who's about to get one, send this to them. Not because the system is broken beyond repair, but because the single best defence against financial vulnerability has always been the same thing: knowing exactly what you're dealing with. The house is yours. Now understand who owns the debt.